Lately, there's been a lot of discussion about how MSTY works, especially on Platform X, where many people talk without really knowing the details. So in this video, I'm going to explain exactly what MSTY is, how it should be played, and who is behind it, all in a clear and hopefully easy to understand way. MSTY is a fund that literally tries to monetize MicroStrategy volatility. Basically, it sells short calls based on the current implied volatility. A clear example: you can go to MicroStrategy option chain, set it to 30 days and check the implied volatility. That number gives you an estimate of how much yield MSTY might generate that month. I'm not just making this up. Jay, the fund manager, say that in several interviews. So you can see that dividend per share in MSTY is a function of MSTY price action that is tied to MicroStrategy performance and implied volatility of MicroStrategy. The cool thing is that Jay sells calls on a weekly basis. That means there can be weeks where the implied volatility is higher than what the 30-day implied volatility suggests, so the yield could end up being a bit higher or lower. Here is an example of how Jay talks about choosing strike prices. He always follows the implied volatility that the market is signaling. This is because implied volatility basically tells you the range where the price is expected to land about 68% of the time. That's one standard deviation. In simple terms, he sells short calls at the strike prices the market doesn't expect MicroStrategy to go beyond. The idea is that the stock can go up, but not too much, just enough to stay below those short calls. That way, the fund earns returns both from price appreciation and from the premiums collected by selling those short calls. You can see that you cannot earn more returns than the short call they brought. So you can see in this example that MSTY can gain more returns if MicroStrategy broke that strike price. Alright, in this second part I will explain what makes this fund different. MSTY doesn't just sell short calls, it actually uses call credit spreads. That means it sells short calls at the strike price I mentioned earlier and then buy further out long calls to protect the upside. Why? Because MicroStrategy can have some wild upwards moves, and this setup allows the fund to still benefit from those. What does this do? It makes the fund capable of capturing big bullish moves. Something people thought was impossible with this kind of a strategy. You can see in this example, between these strike prices, this is the short call and this is the long call, MSTY will be capped, being like a traditional cover call. But if MicroStrategy broke the 350 price of that week, MSTY will gain roughly the same upside as MicroStrategy, as you can see in the P&L graph of MicroStrategy. This is exactly what MSTY tries to replicate. So, in short, what MSTY does is adjust these short and long calls to target a yield that roughly matches the MicroStrategy implied volatility for the month. That's why MSTY has a fee close to 1%. What Jay does is carefully choose the number of contracts and the strike prices to optimize the call credit spread so that it delivers a yield in line with MicroStrategy implied volatility. Pretty amazing, right? A yield that tracks volatility plus the chance to catch strong upside moves. You can see that MSTY does an average weight yield premium. They have so many short calls and long calls that the output of the weight average is the MicroStrategy implied volatility for the month. Okay, in this third part I want to share how I personally use MSTY and also what Jay, the fund manager, has recommended, and that is to reinvest part of the dividends the fund pays out. Why? because the goal is to keep your exposure to price appreciation. If you use all the dividends for other things, it's like you are slowly reducing the weight of MSTY in your portfolio. What really matters here is growing the number of shares you hold, since you get paid dividends per share. Remember that. Another important point, many broker platforms might show you are in red when you reinvest dividends, but that's just a calculation error. They treat reinvestment as if you are putting in more of your own money, when in reality you are just using the dividends you already received. You are not adding any extra cash out of pocket. Personally, I reinvest 50% of the dividends back into the fund, but that's up to you and your own needs. Another important point is that what really matters with this kind of fund is the assets under management. Like I say, the only thing that's important for you is to multiply the number of shares you have by the current price of MSTY and see if it's higher or lower than your original principal. I hope all of this makes sense. The main thing you need to understand is that a fund can capture those wild bullish moves because of its call credit spread strategy. It's also crucial to reinvest a part of the dividends to keep exposure and grow the number of shares you own. MSTY price could drop, but if you own a large number of shares, you won't feel it as much, as long as those shares came from reinvested dividends. So I recommend keeping an Excel sheet where you track how much money you initially invested, your principal, how much you have reinvested from the dividends. Remember, you are not adding money from your bank account, it's still from the same principal. And then calculate how much your position is worth right now. That means the number of shares you own multiplied by the current price. If the result is higher than your initial position, you are making a profit. If it's lower, then you are losing.